Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome Paul Bingham to our podcast. Paul serves as an economist for S&P Global Market Intelligence. Paul manages economic analysis of supply chain transportation and trade for companies and public agencies worldwide. He has extensive experience forecasting modal freight markets and analysis for beneficial cargo owners, carriers, terminal operators, and government transportation agencies. His research has included economic impact analysis, quantitative market analysis, scenario forecast modeling for transportation networks and facilities for all modes of freight transportation. Paul has worked with shippers, carriers, infrastructure investors, and public agencies to assess trade demand and trade policy implications for logistics networks and also facilities. His work with supply chain logistics and commodity flow databases includes consulting applications of the S&P Global Trans-Search, Global Trade Analysis Suite Forecasting, Peers, Panjiva, AIS Live, Commodities at Sea, and other S&P Global data products, as well as national, government, and industry supply chain statistics. Paul, welcome to our podcast.
Hey, Jeff, great to be with you today.
Yeah, absolutely. Um, Paul, there is so much to cover. There's so much going on, seemingly by the day, by the hour, whatever, however you look at it. Especially when we view sort of your sweet spot, that being global trade and all things related to it. Just in the interest of time, Paul, we could kind of start with sort of the most recent first as it relates to tariffs. And now, of course, that could have changed since we started this introduction to this podcast. But by recent, I mean, I mean the 25% reciprocal tariffs placed by Canada on the U.S. in response to the U.S.'s blanket steel and aluminum tariffs, which were previously enacted. That's one of many pieces, I guess, of the tariff scorecard or cheat sheet that I guess we're all using these days.
Yeah, well, we're seeing response by the countries that are having tariffs imposed on them by the United States. I'd characterize what Canada has just done is consistent with what was anticipated, where it's a measured quantity of tariffs that are being put into place at this
Yes.
stage in response to what the United States has done. Clearly, they're not pleased with this, but they're taking what is commonplace everywhere in the world, which is when a foreign trade partner imposes tariffs on you, the politics are such that you must show some response. There've been very few exceptions to that through history, though recently we've seen the Australians trying to exercise some restraint. But by far, what's happened with Canada is what would be expected, which is a measured response to put tariffs on certain commodities selected for, I think, their political impact more potentially than their financial impact or specific industry impact in terms of companies. It's more targeted towards the political impact that those will have.
Okay. Okay. So now south of the border, our other immediate trading partner, Mexico, there's also a lot cooking there as well, Paul. And I noted the 25% matching tariffs the U.S. placed on Canada and Mexico were again subsequently paused for a 4-week period. Well, in just a couple of weeks from now, that 4-week period will be coming to an end, and that also times up with the United States previous reciprocal tariff announcement. So, I mean, there's a lot going on there. Why don't we look at it, I guess, as a two-part approach, Paul? First, just strictly U.S. Mexico, what's happening there, what could be expected, and then we can kind of take a look at the reciprocal tariffs that I just mentioned as well, which were previously announced by the White House a few weeks back.
Yeah, so with Mexico, now our biggest trading partner, that 25% that was put into place, we saw the adjustment for, as you indicated, the pause period where the tariffs were only in place on those commodities which did not qualify for certification under the U.S., Mexico, Canada trade agreement that President Trump had negotiated in his first term. which covers, very roughly something like about half, or maybe a little bit more, because not all commodities that would qualify have bothered to get certified because they were previously not subject to a tariff. Um, that leaves still a substantial portion of that U.S. Mexico trade affected, and Mexico similarly. Um, Not rushing, but moving ahead with a response in terms of imposing tariffs. And now with the proposed reciprocal tariffs coming April 2nd, not that far away now,
Yeah.
that will expand again, both the rates and the commodity coverage. And importantly, I mean, we might want to talk about this more. That is threatened against the entirety of U.S. trade partners, not only
Hmm.
Mexico
Right.
and Canada and China. The Trump administration has started with the big three trade partners of the United States, and the tariffs on China, which we haven't talked about, are in place as well, and had recently gone up another 10%. So
Yep.
there's
Yep.
quite a bit that's already in place, and more coming relatively quickly. In fact, substantially more, if in fact that reciprocal tariff proposal goes forward with all trade partners of the United States.
Yeah, I mean, and you had just mentioned China. There was the initial 10% levied early on, and then recently the White House issued another 10%. Giving us the 20 here. Obviously, there's a lot of tension, but there's a major trade deficit. We import a ton of stuff from China, as has been
Hmm.
well documented over the years. Um, well, it's kind of like a what now thing. I mean, China's economy isn't doing so hot relative to past performance, right? So, I mean, their U.S. Facing trade activity represents a lot of their economic output. It would stand to reason. I mean, there's a lot going on there, or a lot to unpack, I guess. How do you sort of view the current U.S. China landscape as it relates to all these moving parts?
Well, the mainland China's economic challenges are extend beyond just the trade relationships, as you indicated. They have been frustrated by attempting to jumpstart consumer domestic demand within China, and the threat of deflation from some of the sectors in their economy that face tremendous headwinds, such as residential real estate and some of their other markets, financial markets, and so forth, that are not achieving the targets that the Chinese leadership would prefer to have. And we
Sure.
see that their exports are challenged not only directly by U.S. tariffs, but their attempts to work through Chinese-owned enterprises, working through other intermediaries, such as foreign direct investment from China into other countries, such as Mexico or Vietnam, which similarly, if these tariffs affect other countries, indirectly affect China in the supply chains of the world that are complex and where China is present in many of them. Also, I should add that the tariffs, you noted that this was an increment of another 10%. You can call those the stacking of tariffs. So on
Sure.
China, particularly, that becomes an addition to what was already there. And if you remember, there were tariffs that go all the way back to the first Trump administration that the Biden administration did not remove on imports from China. So these fees are on top of that. It also expands the commodity coverage for those that previously had had waivers or exceptions. So it's a much more extensive set of additional tariffs, and it's not clear that the Trump administration is done. With the reciprocal tariffs going in, that will further escalate some of the U.S. import tariff rates against goods coming from mainland China, which presents headwinds to the economy in mainland China, as they face a loss of potential export volumes that they've had. There may be some offsets, such as a currency exchange rate shift, but even there, we've seen the Trump administration maybe indicate that there might be some policy. We haven't heard that directly from the president yet, but there's some of his advisors have indicated perhaps the natural strengthening of the dollar that tends to follow these periods. They may try to somehow soften to try to hurt the or reduce the impact on U.S. exporters from a stronger dollar and from what is likely to be tariffs imposed by other countries, in addition to what we've already seen from Canada and Mexico on U.S. exports.
Okay. Got it. Got it. And then, You know, there's been it's kind of given all of this activity, it's fair to say, Paul, has given shippers a fair amount of whiplash. Tariffs are on, tariffs are off, these new separate tariffs may be coming. Uh, there's just a lot to sift through there. Um, how would you describe sort of the approach that shippers need to be taking or things they need to be mindful of? Now, I'm aware, obviously, that this probably varies based on the certain verticals shippers are respectively in. But on more of a top level, I guess, what are some of the things they need to be doing and following and preparing for, if you will?
Well, in a more protectionist world, if we're thinking at the top level without getting into individual industry sectors or supply
Right.
chains, it becomes critical to understand a more protectionist world makes the global supply chain operations less efficient, more expensive, and therefore domestic sourcing has to be at least considered. In some industries, it's not practical and not
Yeah.
logical, but in others, there may be some ways to mitigate a little bit of the tariff impact, which is the whole, not the whole purpose, but one of the traditional historic purposes of tariffs was been to protect U.S. industries. Clearly, the steel and aluminum tariffs being imposed by the United States are directly that as an example. But for supply chain managers in general, monitoring the tariff policies, no matter how quickly they're changing and what the level, still to pay attention to what portion of those, which commodities, which trade partner countries are relevant for their supply chains, and not just their first tier suppliers, obviously, but going back in the supply chains. Also paying attention to the US dollar exchange rate for the trade partner country currencies in which you got the trade, because that can also affect, it can if those foreign trade partner country currencies weaken, that can actually offset some of the tariff rates. On the other hand, if they don't, that tells you another signal in terms of comparative costs for the landed costs for imports from alternative suppliers that you might consider in different source countries. Obviously, one of the first reactions of supply chain managers, if the tariff rates make very expensive importing uh, being faced for their primary suppliers, to look for alternatives if they haven't already been doing that, going back to the pandemic, to look for alternatives. But
Hmm.
clearly at this point, that has to be part of the everyday duties. There's also for supply chain managers, managing the risk is that also considering what your inventory carrying costs are, what your projected sales are, to manage so that you don't get stuck in a situation where you've tried to advance too many imports and then you find you can't sell all those for whatever price reasons. You're still going to face price competition. There's also, for some supply chain managers, there's opportunity in this. If you're in a situation where your cost profile is going to put you in an advantage to a competitor who is more directly hit by the tariffs, that might give you some pricing leverage and some positions in the market. Clearly, domestic producers that are going to be sheltered by tariffs may enjoy some brief pricing power, where inflation overall will give them cover to raise their own prices. And that's we've seen that already in the steel and aluminum markets, where the U.S. domestic prices rise towards the tariff level of imports, and that provides some opportunities for some companies. But obviously, it can go away, because if the tariffs are removed, if they're negotiated or bargained away or waivers are granted, really is in this context for what's happening now. It really requires ongoing, unfortunately, day by day following what the tariff rates are and the announcements that are coming and the timing.
Okay, got it, got it. And I mean, obviously, a major impetus for all of this is, to perhaps bring back domestic manufacturing in a meaningful way. But that's that's a very time-consuming, expensive, laborious task, to say the least. And it requires a fair amount of visibility. To be fair, that visibility, based on a lot of sentiment that's been out there, is simply not there at the moment, and it's creating some pain, right? I mean, I guess I would like to kind of shift that just over to the automotive side, maybe
Hmm.
from their perspective, just using the automotive sector as an example, because it's gotten a lot of attention lately. How do you sort of view that potential when we view it from a manufacturing perspective?
Wow, there's tremendous stress on what has been evolving over really more than 2 decades, well, going back to NAFTA, really, of an integrated North American automobile manufacturing industry, and to impose on that the 25% tariffs, or backing away from that from U.S. trade policy, causes tremendous stress on the auto industry because it's so integrated in terms of the components. The tier suppliers in the auto industry depend on tremendous amount of cross-border North American trade, and if you're tariffing every individual increment of that, the tiered cost of that in terms of the production cost and therefore the sales prices required on those vehicles affect consumer affordability, will affect demand, it'll affect sales, and our colleagues over in S&P Global Mobility have already said that very quickly, within less than a month, you see effects that will carry right through to production levels at the plant in
Mm-hmm.
North America, that you will see reductions in output of motor vehicles if those tiered tariffs through the supply chain work their way up to the finished motor vehicles, and that the automakers that have been using, and this includes the big three. I mean, it's not only the foreign owned automakers, this includes the US automakers facing much higher costs and therefore higher selling prices and reductions in sales. There's just no getting around what they face because they can't move fast enough to reshore everything into the United States.
Yeah.
Even if you said that your intent to do that, it's not, as you said, to actually have capital investments, to build plants, to build the suppliers of the materials that feed them, to have trained workforces, does not happen quickly.
Okay, got it. And then, I wanted to why don't we shift back to the couple ocean related things that have been getting some traction of late. And one was the recent announcement by the United States Trade Representative that, they're kind of vetting that possibility of charging Chinese flag vessels pretty major fees to enter U.S. ports. I think it was something like $1 million or million and a half dollars. I can't remember
For
that.
most size ships, yeah,
Yeah,
it
yeah.
depends.
So,
The
I
larger
mean,
ships.
yeah, and that would be there's been a lot of subsequent talk indicating that would mean they would only these vessels would only call on the largest ports and bypass the smaller, more regional ones. And there's a lot of what ifs there in terms of what that can mean um, from an import perspective. Now, obviously, this is far from the finish line. I think the White House is currently reviewing some things in regard to this, and we're supposed to see more clarity, I believe, in April. But now, just looking at it now on the surface, how do you sort of view that in terms of what that could mean for freight flows, for imports, et cetera?
Well, we just heard at the TPM conference, just this earlier this month, that hearing on the 24th that the U.S. Office of the Trade Representative is holding will provide opportunities for those in the industry to comment. And it was clear what they said. We've heard this right from the CEOs of some of the major container operators, that they would reduce their U.S. port calls. Typically those liner vessel services that are on a weekly schedule, they call more than one port on the coast. If they're an East Coast serving port, they or service, they'll call New York, Savannah, Charleston, Virginia, Norfolk, Baltimore. Some variety of those ports, and they've said, if you face that fee at every port call, the tremendous incentive is to put larger vessels into one port of call and handle that cargo through that one port. That obviously favors the biggest ports on the coast, like New York, New Jersey on the East Coast, or Houston perhaps on the Gulf Coast,
Mhm.
or LA Long Beach on the West Coast, and that there's a potential risk that those facilities would not have the throughput capacity to concentrate, the entirety of liner trade through, one port on each coast, including the dislocation of all of the inland service trade, whether it's the trucking or the rail side of moving those goods to final destinations within the country. But those port fees are not only on Chinese flag carriers; it's also extends to any foreign country owned steamship line that operates ships built in China.
Okay.
The real target of that, if you read the proposal, the way they indicate it's really intended to support the rebuilding of the U.S. shipbuilding industry, not
Mhm.
so much just to have U.S. flag vessels, but actually have vessels built in the United States. And so it goes to the country of build of the ships. And if you own Chinese ships, even if you don't deploy them on routes that call US ports, if you own them in your fleet, you're still finding yourself assessed these port entry fees under that proposed policy change from USTR. It's and it has a ramp up period for some of the other aspects. It's a rather complex proposal, but ultimately it looks to be an attempt to jumpstart and protect and put some um, federal incentives directly monetarily, not only on not this isn't on beneficial cargo owners. Those that pay this are the the ship owners,
Hmm.
the operators, and it doesn't even mention whether the ships are loaded. It's not on the cargo. It's at the vessel level, and that's a radically different kind of a trade policy than we've seen the U.S. impose previously.
Yeah, I mean it's definitely different, and it could subsequently also have it would stand to reason have a significant impact on ocean freight rates too, right?
Well, yeah, for sure. If you're changing the capacity deployed, as one of the CEOs at TPM said, they can redeploy their ships on other routes for which are more profitable in the world that don't have to call the U.S. ports. They're not under any
Hmm.
obligation to serve the United States, and if the profitability is not there, their own shareholders will pressure them to find deployment for their vessel fleet, which earns them a greater return. Um, that implies then rates would have to go up to continue to offset that somehow, and that for certain shippers that may be more challenging than others. This is not just applied to container ships, by the way. It's all vessels. So the bulk exporters and those companies that depend on certain resource commodities being imported, all of them would be affected by these port call fees. And there is a gradation in the fee assessment up to a certain size, but for the large majority of the major transoceanic shipping, all of those ships are at the million or the million and a half fee level, depending upon where they fit into which category of ownership and the Chinese built vessels.
Okay. Okay. Interesting. And then the other big happening as relates to ocean shipping was obviously down in Panama with BlackRock, a major U.S. investor. Kind of gaining control over the Panama Ports Company. It was a big $23 billion deal at a time where the US, well, President Trump specifically has really talked about wanting to take the Panama Canal back. That deal is in regards to two ports, one on each side, the Pacific and Atlanta entrances to the canal, and BlackRock's buying them from CK Hutchison Holdings out of Hong Kong. There's some major implications to that deal, one would assume. How are you guys seeing it, Paul, in terms of
Well,
what it can
yeah.
mean?
Let me say clarity. There were the two terminals, one on either end of the Panama Canal, that had been under lease to Hutchinson, that were part of that deal. But that was a global deal. That was not
Yeah,
only Panama. That was a Hutchinson, with the exception, I believe, of two ports that they were retaining um, in Asia. They were basically exiting the business of the terminal operating, and
right,
BlackRock there was teamed with the Swiss-owned terminal operating subsidiary of Mediterranean Shipping. So it wasn't solely a U.S. deal,
right,
though.
right,
Obviously, BlackRock supplied a lot of that capital, but that's
right.
also that's a deal that if you think of operationally for MSC, as they've gone into a different operating stance in 2025 as the alliances have realigned. At MSC specifically, has gone out on their own with a new operating paradigm for how they're going to attempt to compete in the ocean container shipping business, having control of more port terminals or ownership of more port terminals globally. Gives them some potential greater control of the operations of their own network as they put their ships into those port terminals, which previously were being owned and operated by others. So I think there's, yes, that perhaps was triggered, and I don't know that for sure, but certainly seems to be in alignment with what the Trump administration had been saying about China interest in Panama. But very quickly, BlackRock and MSC making a move like that is not just about the Panama Canal at
Yeah.
all
Okay.
in that respect. And then that really removes any remaining China mainland China owned operating facilities in Panama. And I don't know if that's going to change the Trump administration stance towards the Panama Canal or not. I mean, that's not clear.
Okay. Okay. Um, and just in a few minutes we have left, Paul, why don't we just hit on a few more, I guess, domestic or economic indicators when we think about the U.S. freight economy. And the first one I thought of was just retail sales because they came out this morning.
Yes.
They saw some mild growth, but at the same time, if you look at the numbers and you look at the rate of growth relative to the preceding ones, it looks like maybe some tariff unease could be kicking in among consumers. 1 month does not define a trend. The fourth quarter was obviously very strong.
Yes.
Um, should we view this cautiously, the numbers that came out today, or is there more to it, or just
Yeah, I think you're right. There's caution advised here. That number that came out, there was some rebound. It was 0.2%, which
yeah.
is rather weak, but compared to what happened with January, which also was revised in the announcement today, January was down sharply. And in conjunction with the consumer sentiment numbers that came out the end of last week, having
Hmm.
fallen again and falling substantially, there's certainly signs for concern in terms of the strength of the U.S. consumer, which has been, carrying along the economy for, so long now, going way back to the pandemic recession. Whether or not the consumer is going to pull back further is not clear. That the employment has not fallen that much. Wage growth has continued. In fact, perhaps higher than the Federal Reserve Board would like.
Hmm.
Um, and so it's not clear yet that we're in a more substantial slowdown. The S&P Global Market Intelligence latest forecast is for what they're describing for 2025 as a growth recession, not a recession in the traditional sense that the business cycle dating committee of the National Bureau of Economic Research is going to say yes, we were in recession, but it's a below potential performance of the U.S. economy in 2025, faced with higher than anticipated inflation, slower growth, slower spending, slower business investment, and obviously on the government side, some unknown but some probably decreased government expenditures, combining to now lower the growth forecast for 2025 to that top line gross domestic product number of 1.9, which is a downward revision from our prior forecast.
Yeah.
And compared to the performance that the U.S. economy had at a 2.8% growth in 2024, is a substantial downshift in the rate of growth of the U.S. economy this year.
Yeah, absolutely. Um, and I also was curious because the inflation number had recently come out and it dropped maybe 2 basis points. I think it came in around 2.8%. So slightly down, but still kind of hovering in that same territory. You see some mainstream press articles talking about the potential for stagflation, which I don't think anybody obviously would want. Um, but at the same time, as you'd indicated with the GDP number, it could be something we're going to have to kind of acknowledge and deal with. Do you think there's more room to run with inflation falling, or do you think we're going to remain sort of in this high two, low three range that we find ourselves in?
Well, the latest forecast that we have for this year, which includes some tariff assumptions and some other factors, we are forecasting the US CPI, that top
Yeah,
line
yeah,
consumer price index, for the year at 3.2%. So we're still well above that Federal Reserve Board 2% target. And likewise, we have now made a policy assumption for this year for what their actions will be, that they will not reduce the interest rates further. They'd taken steps last year when inflation was coming down, and then in the last meeting they put a pause on that. And our current assumption is that's going to continue. in a pause mode through the end of 20, or at least till December of 2025, because of inflation still running higher than their target by not a small amount, and not continuing the decline that we had seen in 2024.
Right. Okay. It's gonna be interesting to follow that. And then just the last one, Paul, before we wrap here, just simply had to do with manufacturing. If you look at the ISM numbers, I believe their
hmm
benchmark reading, the PMI, has actually come in at 50 or above the last 2 months. Encouraging, to say the least, given what a downslide manufacturing had been in. I think it had been down like 26 to 27 previous months or something like that. I
Yeah.
something like that, if not exactly that. But um, the last ISM report, like a lot of other things, cited tariffs as a big concern. Um, what do you think about sort of the current state of manufacturing early into the year, with us almost wrapped up, with Q1 almost wrapped up?
Well, we have for this year actually a continuation of this initial sort of green shoots of recovery in manufacturing that we saw towards the end of last year. But it's a very weak recovery. It just gets it to positive. Industrial production actually going positive compared to last year, where we actually had a very small decline. With some of the payoff coming from some of the areas where you've had investment that takes time to play out in manufacturing output and capacity. Some sectors doing better than others. We still have growth in sectors that are related, say, to AI and the data centers. So some of the electronics and manufacturing that feeds that. There's also some construction that gets fed by some manufacturing demand that comes from some construction in certain pockets that have seen strength. So that it's by far not something that we would call, a healthy manufacturing condition, but it's better than last year in terms of it being a um, somewhat stronger move towards growth that has downside risk to it. But at least right now, even with the tariffs, we believe that there's enough domestic demand in place and some momentum behind investments that were made toward the end of last year, and perhaps even into January, as the before the mood really changed in terms of expectations in
Yeah.
2025, that carries out for several quarters and keeps for the year industrial production actually increasing slightly.
Okay. All right. Great. So, Paul, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd just like to offer up a big thanks for spending some time with us today. The timing was really good, just given everything that's going on out there. But maybe we can have you back on in a few months, and we'll see where things are at. Um, and for those of you listening in, please feel free to give us a follow on Twitter. That's simply at logisticsmgmt. And also, if you're not subscribed to our podcast, please just simply go ahead and do so. Um, Wherever you get your podcast, just look for Supply Chain 24/7 and it'll pop right up. And Paul, it's okay for people to learn a bit more about you over at your LinkedIn profile. Is that right?
Absolutely. I will see everybody on LinkedIn.
Okay, absolutely. And Paul has a lot of really good posts from time to time, and definitely worth checking out. All right, everyone. Well, listen, thanks for joining us today, and we'll catch up with you next time. Have a great
Thank
day.
you, Jeff.
Okay, thank you, Paul.